Have you heard about rising interest rates? Are you unclear on what that means for affordability and for monthly payments if you're thinking about buying or selling a home? Check out this episode of Tom's Take. We're going to break down the financials to the penny to show you exactly what that means for buyers or sellers. Welcome to Tom's Take. I'm Tom Toole. This week we are talking about rising interest rates and what that means for buyers and sellers in terms of monthly payments and affordability. So I've got some weird math equation behind me here. It says a 1% increase in mortgage rates will turn into a decrease of more than 10% in affordability for a home. So let me say that again for you. A 1% jump is going to decrease affordability by 10% for buyers. And that will not only affect what they can buy and what they can afford, but what they're willing to pay for a property and what they're going to be able to afford for a new home. So this affects both buyers and sellers. So let's break down the financials and see exactly what it means. So the average sale price in our market, we'll call it $330 or so, plus or minus. On a $330,000 property, putting 20% down at 4.625%, where rates are coming in today, the principal and interest will be $1,356.92 a month. If that rate went up to 5.625%, you're looking at a principal and interest portion of your payment of $1,519.27, up 11.9%. That is an 11.9% increase in what it costs the buyer. So the people in the 60s, 70s, 80s, when they had double-digit interest rates, they're probably laughing at us right now that we're worried about mid-5% rates. All the economists are predicting that's where they're going to be. So it's really critical to understand that it's not just about where the rate is, but what it does to the mindset of the economy. And when someone can only qualify for X, and the home is priced at X, but then rates go up and the payment goes up by 10%, that affects what they can buy. There's no question about it. So what this means for buyers and sellers is this. If you're buying a home right now or you want to buy a home next year, I would urge you to call your agent, talk to your lender, make sure you understand what those numbers are going to look like. Buying a home fundamentally comes down to what your payment is, how much cash you need to get in, and obviously whether or not you want to live there. So let's get clarity on the first two, and then you can identify that right property for you. And if you're not getting advice right now and you're sitting on the sidelines, you're making a mistake, because the home priced at the same number today that it will be 3-4 months from now, it's going to cost you more and you're not getting more for your money. If you're a seller and you're thinking about waiting until the spring, there's going to be more inventory. There's going to be upward trending rates. It is very clear. So all of a sudden, the buyer that can buy your home today when inventory is still low, they want to buy your home in the spring, it costs them more. That may affect what they want to pay for the property. So no matter what you're thinking about doing here, it is critical to understand the financials. What I'll leave you with is this. There's two factors that are not happening right now that will tell me we're not in a bubble, the economy is going to stay strong, and the housing market's going to stay strong. It's just slowing down. Slowing down is the key word here. One, there's a lot less real estate speculation. And two, there's stricter lending practices to prevent people from buying a home they really shouldn't. So a lot of numbers, a lot of data for you. If you want a specific financial model built out for your property or built out for the home you're looking to buy, contact us directly. We're here for you. We're ready to serve. Otherwise, we'll be back next week with more great content, and appreciate you watching. Take care.